There are 4 groups of UK tax relief built specifically for companies that innovate, and most early-stage founders claim none of them. SEIS and EIS make your deal cheaper for investors to back. R&D tax credits put cash against the cost of genuine research. Patent Box cuts the tax rate on profits from your own IP. Capital allowances accelerate relief on equipment. In the next few minutes, you'll get the mechanics of each. Accurate figures, plain English.
Think of UK tax reliefs in 2 columns. Investor side reliefs, SEIS, EIS, and VCT, reduce the personal tax bill of the people funding your company. They make your deal financially attractive to back, which is why UK angel networks specifically look for SEIS-eligible or EIS-eligible rounds when choosing where to invest. Company-side reliefs, R&D tax credits, patent box, capital allowances, directly reduce your corporation tax, or in some cases generate a cash payment. For a visa application, demonstrating that you understand both columns and have designed your funding strategy around them signals the commercial maturity that endorsing bodies look for.
SEIS is for very early companies. Investors get 50% income tax relief. A £50,000 check costs $25,000 after tax. The investor's annual limit is £200,000. Your company's lifetime SEIS cap is £250,000. EIS is for slightly more established businesses, 30% relief, with investors able to put in up to £1 million per year. Your company must be within 7 years of its first commercial sale, 10 years for knowledge-intensive companies. On both schemes, investors pay 0 capital gains tax on shares held 3 or more years. VCT adds a third option, pooled funds giving 30% income tax relief, tax-free dividends, and CGT exemption on disposal. Before you pitch any of these, apply for HMRC Advanced Assurance. It costs nothing and removes the main friction that slows deal closes. All figures as of the 2026-27 tax year. Verify at gov.uk.
R&D tax credits reward genuine innovation costs. HMRC applies a 2-part test. First, the project must aim at an advance in overall scientific or technological knowledge, not just knowledge new to your company. Second, it must involve resolving genuine uncertainty that a competent professional in the field could not readily solve. Routine development and adapting existing methods do not qualify. Eligible costs include staff salaries and NICs, materials consumed in the R&D process, relevant software licenses, and qualifying subcontractor spend. Since April 2024, most companies use the merged scheme, formerly called the Research and Development Expenditure Credit. Loss-making R&D intensive companies can receive a payable cash credit rather than a deduction against future tax. This relief is not automatic. You claim it through your company tax return. Verify current rates at gov.uk.
If R&D credits reward what you spend on research, Patent Box rewards what you earn from it. A UK company that owns or exclusively licenses a qualifying patent can apply a reduced rate of corporation tax to the profits attributable to that patented invention, significantly below the standard main rate. The patent must come from the UK Intellectual Property Office, the European Patent Office, or a short list of specified European offices. There is also a development condition. Your company must have been actively involved in developing the patent or a product incorporating it. The structure of your IP ownership now determines whether you can access this relief later. Getting it right from the start is considerably cheaper than restructuring. Check the current rate at gov.uk.
Capital allowances determine when your company gets tax relief on physical assets, equipment, machinery, servers. The headline route is the annual investment allowance, a full 100% deduction in the year of purchase up to the annual cash limit. Full expensing, made permanent from April 2023, gives the same 100% first-year deduction on new main pool assets with no upper cash cap. Where assets fall outside those routes, you use writing down allowances instead, 18% per year on the main pool's reducing balance or 6% for special rate assets, such as long-life equipment. That spread matters. 100% relief in year 1 has a materially different cash flow impact than 18% year after year. Verify current limits and rates at gov.uk.
SEIS and EIS make your deal cheaper for UK investors to back. R&D tax credits put cash against your genuine innovation costs. Patent Box cuts the tax rate on profits from patented IP. And capital allowances let you take equipment relief now rather than in small annual installments. All 4 compound for the right innovation business. The full guides are in the Financial Fluency series at torlyAI. Run a free assessment while you're there to stress test the financial section of your visa business plan. This has been educational, not financial advice. Reliefs and limits change. Verify at gov.uk and consult a qualified accountant before you claim.